afternoon. Today, we are pleased to welcome Metair to Unlock the Stock. This platform was created for retail investors to connect with corporate management and to get a better understanding of them and their companies. We are joined by Paulo Flaherty, the CEO, and Alastair Walker, the CFO of Metair, who will take you through the company's presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. You can visit their website at lumiglobal.com to discover more about their various online AGM and investor presentation solutions. Before we start, we have a few housekeeping notes. The company's presentation will be followed by the Q&A. The Q&A session is hosted by the Finance Ghost and Mark Tobin of Coffee Microcaps. You can post your questions by typing them into the chat box, which is at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon. You will also see an email address before we begin the Q&A session. Please can you take note of it if you want to be added to Metair's investor distribution list. I'm now ready to hand over to Paul and Alastair to take us through the presentation. Paul, are you able to share your screen with us and take us through that presentation, please? There we go.
Good. Thank you. Good afternoon to everybody. Thank you for this opportunity to talk about Metair Investments. We're going to just cover a little bit about the SA automotive industry because from Metair perspective, we are the only listed company in the direct manufacturing of automotive industries in South Africa. They obviously CAP has a subsidiary called Feltex, but Metair is the primary player in this industry. And in terms of latest financial results and look at our outlook and prospects. So if we take the automotive industry, the larger industry, which consists of the OEMs and the component manufacturers, and interestingly enough, this excludes all of the aftermarket section of the industry. So this is direct of the OEMs and the auto component manufacturers. These are 2024 figures, and this industry contributed 5.2% to the GDP of South Africa. It employs 115,000 people, and it exported to about 155 countries across the world, and very significant export earnings of just under 270 billion. So very key, important industry for South Africa. If we look at the SA auto components, so the people who manufacture the component parts for the industry, and you can see on the left-hand side all the key OEMs, we have what we call Tier 1, which is direct supply to the OEMs like Metair, but we also have Tier 2, so the suppliers to ourselves who are also in this value chain in South Africa. On the right-hand side, you can see that there is a strong export market for the vehicles in South Africa, and it's primarily into the EU and the UK markets. And on the bottom right, you can see the component exports. So the component manufacturers not only make the component parts for the manufacturers in South Africa, for the OEMs, but also direct exports into the various markets around the world. And catalytic converters would be an example of that. But the industry is in a bit of a turmoil at the moment. If you can see on the bottom left, that is the light vehicle sales. So when we talk the automotive industry, we talk about passenger vehicles and light commercial vehicles. And you can see the levels of sales, although that they're recovering, and these are the sales, that the new sales in South Africa, they are recovering above pre-COVID levels. The big threat at the moment is the significant import of Chinese and Indian vehicles. And so what the OEMs in South Africa are struggling with is to compete against those direct imports, and therefore their only channel they have after that is the export market. If you look on the right-hand side, the entire industry was set up by the South African government. Recently, the SA Automotive Master Plan, and it was to encourage the global OEMs to set up shop in South Africa, to manufacture in South Africa, but most importantly, to push local content. And unfortunately, through a variety of reasons, you can see on the right-hand side that local content is not hitting the mark in terms of the Automotive Master Plan. And there's a variety of reasons for that. And that is really key for Metair. We are local, and we contribute to that local content. And it should be at around the 48% mark at this stage, and it's not. If you look at vehicle volumes in South Africa, so this is what we look at as opposed to the vehicle sale. If you look at vehicle volumes in South Africa, so this is what we look at as opposed to the vehicle sales. We look at vehicle volumes of production. And if you see at the bottom there, last year, 2025, there were 600,000, just over 600,000 vehicles produced in South Africa by the OEMs. Now, going back 10, 15 years, South Africa was over the 700,000. And obviously there was COVID, et cetera, but you can see that the OEMs themselves are taking significant pressure, and about a third of their vehicles are sold into the South African market, and the rest is exported. And as I said, the main places of export would be EU and UK, with a little bit to Australasia, and it's only really Mercedes who targets the US market. So what about Metair? So this is Metair. On the left-hand side, we operate in two distinct verticals. We have our manufacturing companies that manufacture directly for the OEMs in South Africa, and our customers being Toyota, Ford, Isuzu, Nissan, Volkswagen, and Mahindra. And we do everything from harnesses through Hesto, through Smiths, which is radiator and cooling systems, to Supreme Springs, which is the springs, the leaf springs and the coils for the vehicles, Lumitec, who does the lighting, and Automotive, who does all of the plastic parts, so the internal plastic parts and the external plastic parts that you would typically see on a vehicle. And it's also supported by Unitrade, which is a copper producer. It gets the raw copper and it produces that copper directly for Hesto to do the wire harnessing. But we also last year set up and have paid a lot of attention to aftermarket parts. And Metair has always been in aftermarket parts, but due to the pressure that we're seeing in the manufacturing environment, this is a big potential growth area for ourselves, and was the reason towards the end of 24 that we acquired AutoZone out of Business Rescue. So AutoZone gives us direct entry into the spare parts market in South Africa. And you can see some of the other brands that we have. So First Battery has always been part of the Metair stable that produces batteries primarily for the aftermarket in South Africa. And then we also have other brands like ATE, which is brakes, a licensed brand that we sell. We do have two foreign companies currently under our aftermarkets. The one is Rombat, which produces and sells batteries, lead acid batteries for OEMs, but also into the aftermarket in Europe. And then we have a 25% interest in Associated Battery Manufacturing, which is a Kenyan operation, but manufactures lead acid batteries and sells into the East African market. And interestingly enough, also imports and installs solar batteries and solar panels because that market is growing quite significantly in East Africa. If you look at this picture, this really highlights where Metair's subsidiaries, manufacturing subsidiaries, supply into the original equipment manufacturer vehicles. So it's many of those parts. Generally in South Africa, the engines are mainly imported, other than Ford, who would do their own. and also some of the other component powertrain parts are generally imported, but everything else is subject to local content, and Metair is a significant player for the local content in South Africa. As I noted, we have two distinct segments, the auto component manufacturing on the left and the aftermarket parts in the retail. At the moment, the majority of our revenue, about 64% of our revenue, comes from auto components manufacturing. But we definitely want to move our aftermarkets from the approximate 34% to 40% quite quickly, and then over the medium term, probably have half of our business in the aftermarket parts and retail, and 50% of in our component manufacturing. Hesto is the biggest of our manufacturers and is 27% of our revenue, and that would be the wire harnessing. And then you can see at the bottom there, Smiths about 13%, Lumitec 12%, and Automotive and Supreme at 6% of our revenues. On the right-hand side, in the aftermarkets, the battery parts of those businesses contribute, First Battery being 10%, Rombat being 14%. And then you can see in between AutoZone and QSV, which is really the wholesale part of AutoZone, about 10% of our revenue based on 2025. I want to go through this slide first before I go back to the second one. So I joined Metair just over 2 years ago. Alastair joined last year. And really, there were a couple of key priorities that I faced and that the team faced when I joined. And the first was we had to stabilize leadership. And Metair had been through a period where they'd lost 2 CEOs and a CFO all in 1 year before I joined. And it was really necessary to stabilize that leadership and really make sure that the head office took over as strategic control. So the Metair I joined and the Metair that had been operating for many years was purely an investment holding company with a very small head office and lots of delegated accountability with the units. And obviously that model resulted in certain problems that Metair experienced. So putting in strategic control, building up the new executive team was one of the key challenges I had. We've completely filled that. We have a chief financial officer, we have legal, we have HR executive, and we have 2 chief operating officers also in the head office, one for the manufacturing and one for the aftermarket parts. Second to that was the debt levels. There was debt that Metair had directly. There was debt in a subsidiary called Mutlu in Turkey. And then there was debt in Hesto. And Hesto, for a number of reasons, was accounted for as an associate. So the debt pile that was sitting in Hesto, which was contributed by the other partner of Hesto, was not really reflected on the balance sheet because it was accounted for as an associate. So dealing with that, making sure we could have oversight over all the cash and all the debt in Metair was really important before we set down our journey of restructuring. So we fully restructured that debt in FY25. We started to account for Hesto as a subsidiary, as it should be. We ring-fenced that Hesto debt. We ring-fenced the debt in Rombat. That was very important, that there was no contagion to Metair, and we ring-fenced their debt. And we've improved cash management, and by implementing a central treasury, we sweep the cash every day. We have full monitoring of all the cash in the South African operations, including Hesto. And we monitor from the top level, although there are budgets approved for CapEx and OpEx, much of it sits with us in terms of our delegation of authority of what the businesses can and cannot do. The middle section of the flywheel was putting Hesto back to profitability. Hesto had a really onerous contract that it entered into with Ford, and that was back in 23. Significant losses. and was not making any profit. And one of the key issues there, other than sorting out the debt of Hesto, other than equalizing the shareholder loans with our partner Yazaki, was to bring it back to profitability. And that we've done fairly successfully through FY24 and then definitely through FY25. On the left-hand side, we had a number of operations we regarded as non-core. Mutlu is an interesting one. It's a subsidiary it was a subsidiary in Turkey producing, again, lead-acid batteries. But Turkey went into hyperinflation in around 2021. So trying to deal with a country in hyperinflation with interest rates well over 50%, significant double-digit inflation rates, and trying to manage that from South Africa was just not core for us. And so we went through the process of selling Mutlu and sold Mutlu in 2024. And then top at the left-hand side, the EU Comcom. That is a historic issue that arose and was first notified to Metair in 2017 that there was an investigation into the subsidiary Rombat for anti-competitive practices. And then Metair was notified in December of 23 that there's a statement of objection. That's where the EU now goes into full swing, the Competition Commission, and you have to deal with a whole lot of questions, queries, etc. And we've been dealing with that since I arrived in February of 24. And we'll talk a little bit about the fine that was finally determined in December of last year. So a lot of issues that had to be dealt with to make sure that we as Metair and management really focus on what we can control. So dealing with these issues was fundamental to really stabilizing Metair, and we've completed that. So if I go back to FY25, the operating conditions was that, as I've said, the new vehicle sales grew, but local production only grew by 1.5%. So we've spent a lot of time downscaling our factories. Some of our factories are built, for example, for 180,000 vehicles from Ford and 180,000 vehicles from Toyota. That's not the reality. So we've had to spend a lot of time refining the processes, refining the manufacturing, and unfortunately reducing the headcount. If you look at strategic interventions, so we've definitely simplified the structure. We control from the top. We've simplified the management in all of the subsidiaries. We don't operate them as although they are legal entities, we operate this as an integrated operating model. We've entrenched the operational and financial discipline. We've prioritized revenue growth, cost reduction, cash generation. We've eliminated the loss-making businesses. Turkey was one. Dynamics in the UK, we've disposed of that. And we closed down our first battery industrial business. As an example, in 2024, when I arrived, we closed down the manufacturing of our brakes, the ATE, and we purely imported under license because it was loss-making. And we will continue to look at our businesses and make sure we fit for purpose. We've implemented shared services. So we've got significant administrative costs across our organization. The only way to really reduce that is to implement shared services. So for finance, HR, and IT, we've done that. We're busy looking at procurement. And as we said, one of our big strategic interventions was to diversify our revenue, and that was the reason for the acquisition of AutoZone. In terms of our capital structure, and Alastair will talk a little bit about it, and talk about what we're currently doing in that capital structure, because it's an ongoing. We concluded our SA obligor debt of 3.3 in April, our Hesto obligor of 1.4 billion in June. And during 25, we met all of our covenants. We had quite strict covenants in terms of our EBITDA tracking on a quarterly basis from the banks, and we hit all of those. And so from a growth perspective, we have this new aftermarket parts and retail division. We've had to, unfortunately, we've put that all together in November of last year. Unfortunately, we've had to effectively replace the entire management of Metair Aftermarket Parts and Retail, and we've done that. We've done that successfully through December and right through actually until February. We've gone into the market. We've got the best people we can find, and so we're pretty confident that we have the right team in place. The strong profitable turnaround in our OEM businesses has, yes, the volumes went up by 1.5%, but we've really looked at the processes and those direct factory costs, and we're able to flex. So if the OEMs announce to us that their volumes are dropping in 3 months' time, we're able to flex our factories, and that's been really successful for us. So what is our growth strategy? If we look at our component manufacturing, the first was to drive our manufacturing excellence, to improve our efficiency, to remain cost competitive. Because if we're not cost competitive, then a Toyota or a Ford can't be cost competitive. If they can't be cost competitive from a business case in South Africa, selling into global markets, then there is no business case for OEM. So it's really on us to form part of that and work with the OEMs to make sure we're efficient and we're cost effective. We had to make sure that the units understood EBITDA, free cash flow, and continually to deliver against that. And I think the new growth is obviously the OEMs. I would say their production is currently stable, but it's not growing. It will still, I think, for this year be around the 600,000, but they're potential new entrants, which is a good thing. And as long as those new entrants come in through the current structures of setting up manufacturing operations, and I'm talking about some of the Chinese operators, that's good for us, because we as an established business can definitely work with them and grow our business in the aftermarket, in the automotive components. In the aftermarkets, this is an interesting story. In South Africa, and we talk about light commercial and passenger vehicles, there's just over 13 million registered vehicles in South Africa. In sub-Saharan Africa, the estimate is around 30 million. And we spend a lot of time visiting these countries, doing our homework, establishing what's out there. And sometimes it's difficult because sometimes the registration in various of these countries is not the best. But about 30 million vehicles in sub-Saharan. Vehicles are aging. The South African fleet, the 13 million is older than 7 years on the market. And that creates the aftermarket opportunity, the parts and the spares, etc. From an AutoZone perspective, we have around 200 retail branches, and we range around 12,000 SKUs. That's probably grown since November. We're probably at around 17,000. We also have franchises in Namibia, Swaziland, and Botswana, and we're looking actively in sub-Saharan Africa as to where we could grow the aftermarket parts. But the first thing we need to do is make sure we get AutoZone back to profitability in South Africa, in our market. But the aftermarket opportunity for us, we think, is quite obvious. As I said, we've set up this new division in November. It has 5 verticals: AutoZone and QSV, which is the wholesale. But interestingly, we have this concept Move, and Move is an aggregator. Move is a concept where we aggregate workshops and mechanics into a buying platform, and we supply them through the buying platform through catalogs. And so by aggregating the informal market and aggregating the workshops, obviously is good business for us. ATE, we spoke about, a very unique, well-respected premium brake brand in South Africa, and we do that through license. And then we have our First Battery, who manufacture and sell into the aftermarket retail market. Our African growth strategy we've spoken about. We want to see how we could leverage already through the operations we have in Kenya. So we're doing a lot of work there in East Africa. And all of this division is supported by our shared services. So I'm going to hand over to Alastair, and Alastair, you just let me know when you want me to continue. I'll hand over to Alastair to talk about our FY25 results.
Thanks, Paul, and good afternoon to everyone, and thanks very much for this opportunity. So to touch on the financial results for the period ended December 2025, we were very pleased with the financial performance of the group for the fiscal. I think before I delve into the detail, I think just some points which are important in order when assessing the financial performance. First of all, the consolidation of Hesto, it's our biggest business with effect from the 1st of April 2025, is important. It was previously treated as an associate from an accounting perspective. From the 1st of April 2025 has been consolidated. There was no change in shareholding or no funds flow to consolidate. It was just a clarification of the shareholders agreement, which has resulted in that. That has had an impact on the year. The second point to note is the acquisition of AutoZone, which is reflected in the full year. And I think the third point is the improved operational performance coming through. So notwithstanding the revenue contribution from Hesto and AutoZone, you can see the significant margin improvement, which is reflected through the EBITDA and the EBIT increasing by more than the revenue. So the revenue increased over the fiscal by 57% to just shy of 18 billion rand across the group. The EBITDA touched under 1.7 billion for the fiscal, up 99% on the prior year, and EBIT also up 99% to 1.1 odd billion for the year. The group net debt is 3.9 billion at the period end. It's important to note that the net debt is housed in 3 separate clusters, and I'll go into some detail on a further slide. And the HEPS, our key performance metric, 191 per share for the fiscal, up from 105 in the prior year. And ROIC, which is another very important metric that we measure all of our deployment of funds, capital, be it into CapEx or OpEx, is all measured with a strong reference to ROIC, up strongly from the prior year at 11.1%, up from 7.2% in the prior year. Thanks, Paul. So to touch on the performance within the clusters, as Paul alluded to earlier, we really reflect the group in 2 main segments. On the left-hand side, we've got the OEM component manufacturing businesses, and then on the right-hand side, we've got the aftermarket parts. Hesto, we separate out, just given its size. Revenue for the fiscal up to 5.9 billion, up 8%. And then very pleasing, the EBIT performance up just shy of 80%, up to 454 million, which really reflects the operational improvement in that business and a healthy margin at 7.6%. The other OE manufacturing businesses being Smiths, Luma, Automotive, Supreme, and Unitrade, combined revenue 7.3 billion and EBIT of 523. Again, up 40% at the EBIT level relative to a revenue increase of 4%, again reflecting the significant operational improvement in the businesses that commenced in 2024 and came through quite strongly in 2025. So that component delivered an EBIT margin of 7.1%, again up from 5.3% in the prior year. On the right-hand side, we've got the aftermarket parts and retail. So the battery businesses, First Battery, Rombat in Romania, and ABM, the associate, delivered revenue of 4.3 billion, up 2%, and EBIT up slightly ahead of the revenue increase of 292 million. That delivered an EBIT margin of 6.8%. And then the retail cluster, predominantly AutoZone, as Paul has touched on, revenue of 1.8 billion for the year and a loss of 46 million for the fiscal. Thanks, Paul. Paul, do you want to take the Rombat fine or?
Yeah. So in December of 25, the Commission announced that it had imposed fines on all the battery manufacturers in Europe. And Rombat was given a fine of 20 million. It relates to historic conduct from 2004 to 2017, and noting that Metair only acquired Rombat in 2012. And nothing in any of the due diligence documents that we've gone back through and looked at revealed that there was anything of this nature at the time. We are actively evaluating our legal remedies, and in fact, we've lodged an appeal as we dispute the fine. And we dispute the fine on 3 aspects. The first is the quantum. Quite frankly, a 20 million euro fine is probably twice the value of Rombat, if you had to value it today. Secondly, is that they've assigned about half of the fine, joint and several, to Metair, under the concept in Europe that Metair must have known. So that's how they look at parental liability. They don't look at it from the way we would look at it. We dispute that completely. There's no evidence of that in our view. And the third one is Rombat cannot afford the 20 million euro, certainly not in the period, the 4.5 years that the Commission has said that Rombat can pay it in. So on all of those, we're disputing it. And fair enough that we have provided in full, because it's a known liability, even though we're disputing it, and that full fine has been provided in the books of Rombat. Alastair?
Thanks, Paul. So, yeah, to outline the cash generation and cash performance of the group over the fiscal, we started the 2025 year with 808 million of cash. The business has generated 1.7 odd billion of cash from operations, and over and above that, liberated 207 million through working capital release over the period. We paid interest on our debt obligations of just less than 600 million, paid tax of 173 million, and invested into the business 588 million, of which 490 was capex and 185, which was a loan to a related party, which was into Hesto to rebalance some shareholder loans. So we ended the fiscal with a consolidated cash position across the group of just over 1.2 billion. Thanks, Paul. So to touch on our debt structure, as I alluded to at the start, the debt of 3.9 billion aggregate at the end of the fiscal is really housed within three separate obligors. We have what we call the SA obligor, which is all the SA businesses, excluding Hesto. That totals a gross debt of 3.3 billion, which is it's essentially tranched in three structures. We've got a term loan, what we call D, which is an amortizing portion, a term loan B, which is a bullet, and then we've got a term loan C, which is a 1.6 billion bullet due June 2027. We're in the process of engaging with the lenders to refinance and restructure that debt package. So we'll extend the term of the 1.6 billion to a more normalized repayment profile aligned with the earnings growth and the cash generation of the group. So we'll essentially take away that 1.6 billion due in June 27 and term that out for 5 years. That will also see a revision of the interest rates and also a revision of the covenants. As Paul alluded to, we've met all of our covenants on the existing structure, but we'll reset the covenants for the next 5 years. On the right-hand side, we've got Hesto, which is a separate obligor. There's a separate debt structure attached to Hesto, 1.3 billion of debt with sufficient working capital facilities. That's structured in essence half and half between an amort profile and a bullet profile as well. And we've got three covenants there, which we've met and have healthy headroom. The third obligor that I referenced to is Rombat. Rombat has ring-fenced debt managed by its management team in Romania. Thanks, Paul. This slide depicts the capex and the capex spend. It's important to note that the capex for FY25 and also for FY26 are elevated relative to the sustainable capex profile of the group. The reason for that is there's a model changeover for one of the key customers. The factories are investing heavily into that model changeover. So the capex for FY25 reflected on this page, 569. For FY26, we've committed capex and budgeted capex of 837 million, split between maintenance of 288, the balance being efficiency and expansionary capex. But going forward from FY27 onwards, that capex should moderate across maintenance and expansion to around about 450 million per annum. The right-hand side of this page shows return on invested capital. As I mentioned earlier, a key metric that we measure all capex deployment and OPEX deployment is all measured on ROIC. 2023, 13.4, dropped to 2024, 7.1, and then improved in FY25 to 11.1. The ROIC historically has tracked vehicle volumes. So if you compare these ROICs to the vehicle volumes that the business developed or the business produced, quite linked. And through the strategy that we have to really focus on aftermarket and drive aftermarket as a growth, that ROIC should become less volatile and less dependent on vehicle volumes and should improve as we go forward and be less volatile as we go forward. Thanks, Paul.
Okay, so So what are we looking at for our outlook? So the automotive industry, as I said, the manufacturing is at a crossroads. There's currently renegotiation with the threat of the Chinese and Indian vehicles and quite frankly, the flooding of the Chinese into the market. There's 27 Chinese brands currently in the passenger and light commercial vehicles in South Africa. And those of you who can name 27 then are real petrol heads. They compete directly head on, and they have their challenges too. And it's going to be really interesting what happens over the next 2 years. But the automotive industry is working closely with governments. How do we protect the industry? How do we make sure that everybody is kept honest as this flood is happening? In terms of our own and our operating environment, so Toyota is launching their new Hilux in June of this year, and so there is dual production. All our factories are gearing up for dual production coming up now in May, and we're confident we're going to have no blip in this dual production. All of our factories are ready to do this, and the new Hilux will then be fully in operation by 2027, with none of the old Hilux being prepared. We've got some issues with one of our other major OEMs. They have significantly reduced their forecast in production for the current year. That's the other key OEM we have in Pretoria. That would be Ford. But we've reduced our footprint accordingly, and we continue to drive the efficiencies. So we've taken note of it, and it's really up to us to make sure we maintain our earnings, and that's why the aftermarket is important to us. Alastair has spoken about the capex. So our segmental split, we believe, is the right thing for Metair. We currently renegotiating all our covenants, as Alastair said, renegotiating the debt package to give us more relief, and we continue to drive working capital and ROIC. And then on the right-hand side, this return of AutoZone to profitability is absolutely key for us. I spoke during our results. We were about 6 to 9 months behind the curve there of what we wanted to do, but we've taken action, and we're still very confident on the turnaround of this business going forward. So I'm going to stop my sharing and then hand back to the team.
Well, Alastair, thank you so much. I'm going to dive straight in. Mark has graciously let me go first as our resident petrol head. So I just want to say well done on a year of turning around what I've written about many times is probably the unluckiest company on the JSE. It's nice to see that luck starting to change. Maybe it's your Irish background, surely, Paul, with that surname. There must be some Irish luck coming through. But what I wanted to ask is, and it's a tough one straight up, but I think it is obviously the elephant in the room, is the Chinese and Indian threat, clearly. So we know it's there. I don't think it's going away. I can see why people are choosing these vehicles. They offer a lot at the price point that they do. Is there a world in which you might get a chance to actually supply these companies if they set up local manufacturing in South Africa, or do you kind of have to hitch your trailer to the legacy OEMs, traditional OEMs, and hope that they carve out a suitable, size of the market and that you can then operate efficiently?
Yeah, no, before I answer that, I need to give an anecdote. I was at the Toyota Key Supplier Day yesterday, where Andrew Kirby gave his reflections on the Chinese and Indians, which I found very interesting. And he's the one who mentioned the 27 brands and asked us whether we could name them. And their view is the Chinese, as they've done in South America, as they've done in many other countries, their approach, as opposed to the Indians, the Chinese come in and then they just flood the market, right? And they're actually competing against each other. And they try and see what sticks. So some of these Chinese vehicles that have come in don't even have dealerships that they sell it. They sell it through second-hand avenues, but brand new vehicles into the market. So that's the first issue. The feeling is these brands will start to dwindle. They'll remain, but they'll dwindle. The second is there's a lot of questions about the warranties on these vehicles. And there's a lot of questions. There is certainly at the moment no aftermarket services and parts available, right? So you have to wait. But they are at a cheaper price, and they do have all the gadgets. So that's a given. So So the feeling from Toyota is there will be a market correction. But that being said, yes, we see opportunity. We have been engaging with Chery through RFQs, and we have previously engaged with BYD. And those two companies are probably at the forefront of perhaps setting up in South Africa. And that's where the government comes in. So how do we encourage these companies to come in, set up manufacturing? We want them to set up full-scale manufacturing, and we can definitely play a part. We're not beholden to any tech. We do have technical partners that we supply into the vehicles we do, but the other technical partners and design partners we could definitely joint venture with. And so we do definitely see, if those companies set up in the country, that we as Metair will have an opportunity.
Paul or Alastair, I don't know who wants to take it, but kind of a related question to what we just had there on the changing dynamics of the car industry, you know, moving from internal combustion engines to hybrids, to plug-in hybrids, to EVs. I mean, obviously all of that plays into both the OEM business and the aftermarket business. And, you know, we saw a big run up in EVs. Now we've seen a lot of the traditional OEMs pulling back on their EV strategy. Just how does that all, the changing dynamics, demand profiles of the different types of vehicles, how does that kind of play into the go forward strategy for Metair, if I can say that?
Yeah, so in our manufacturing, and maybe split it between the manufacturing and the parts. So in the manufacturing, obviously we're very dependent on the OEMs, and we're very dependent on their strategies. And we continually engage with them on their strategies. You know, two-thirds of their vehicles are exported, and it's mainly Europe and the UK, with some in Australasia. And as you rightfully pointed out, 2030 to 2035, there's all of these regulations of not being able to sell ICE vehicles. So these companies are considering it, but they have to consider it with their parent company, right? So if you take a Toyota as an example, what NEVs, and they like to say new electric vehicles, not battery specific, what NEVs could be produced competitively in South Africa for those export markets. And that's currently the strategy that we see them all undertaking. Ford did introduce the plug-in hybrid Ranger last year, so that's part of their strategy. So we do follow those strategies closely. Yes, government has announced some regulations or some incentives around investing for NEVs, and I think there's a cautious approach from the OEMs currently, but definitely seeing the risk and what they need to do. And obviously Metair would fill in behind that on the automotive components. We've studied all of these we've broken down these electric vehicles. We know the component parts are required. We have technical partners who assist there. So we're ready for that. The question, your right question is South Africa moving too slowly? Because if South Africa moves too slowly in accommodating, given that the landscape is EU and UK, we may lose out. But another interesting fact is in sub-Saharan Africa, the OEMs are seeing still significant potential for ICE vehicles. And that's because of the infrastructure in the countries, including South Africa, as to can we set up for NEVs in these countries quick enough, or will there still be games to play or future of ICE? And that seems to be the intent. The next 6-7 years in the sub-Saharan space, still a lot of future for ICE vehicles.
Yeah, I would personally absolutely agree with that. People don't realize how much regionalization there is in these trends. I mean, Stellantis is the market leader in South America. That's a stat that's always blown my mind. And they struggle so much in South Africa. So it's just a good example of how regional tastes can vary. And speaking of regional tastes, we do love our Hiluxes here. And you did reference some elevated CapEx there around that model and that kind of thing. I guess there's a broader question here from me, which is, and you mentioned onerous previous contracts. So I guess the question is, how do you avoid that happening? Do you get any kind of protection around minimum quantities when you are investing to support a particular model? Or are you kind of wearing the risk and reward 100% alongside the manufacturer? You're kind of going it together.
Yeah, that's the big wake-up call for me joining this industry, right? It's a one-sided contract. We take the volume risk. That was part of the problems that we had to solve, was getting our factories to live in a new world of agile and live in a new world of flexibility to customer volumes, because they are not what we built for. And that we've been pretty successful at. When it comes to the new Hilux, it's dual production for the first 7 months. We've taken a cautious approach. We're working very closely with Toyota on how they see their order book. They're telling us that the new Hilux has been already launched in parts of Asia, has been very, very successful. And they're not seeing why their new Hilux won't be successful. So that CapEx we spend, a lot of it is a lot of our parts are continued parts. And for those new parts, the customer does also pay for the tooling as well. And so we invest with the customer, we're cautious with the customer. I think the onerous contract I spoke about was the Ford contract, and particularly at Hesto, where there was a significant amount invested and losses that were made when those volumes didn't come through. So I'd say if I speak to the veterans of Metair, the eyes are wider open today than perhaps in the past.
One for Alastair, but Paul, please feel free to jump in if you want, because these are kind of more broader strategy question. But you called out return on invested capital there as kind of a key metric that's being looked at on all sorts of expansionary capex, operational capex, business units, I'm sure level as well, and it had a nice tick up in the period, but probably still maybe trending below cost of capital or just around it, maybe given the certain context of interest rates. My question is, as part of the go forward strategy, is there a target the board is kind of looking to get to? I appreciate the two business units probably operate on slightly different right measures, so maybe what that kind of blended thing kind of looks like once it all comes together, if we take a 3 to 5 year view out on getting to that 50-50 split between the two divisions.
Yeah, thanks. So our cost of capital is higher than the current ROIC. It's probably about 3 percentage points higher if you look at the our cost of equity and the cost of our debt and the structure and the blend there. So for sure, our target is to get to that cost of capital and exceed the cost of capital. We think we're probably on a medium-term path to get through the cost of capital. I think it's not in the short term, but in the medium term, for sure, we should get there. I think in terms of allocating capital, that's what we predominantly focused on. The factories are big, they require maintenance. We've got big contracts there, we've got significant revenue from them, so we need to maintain those factories. But the aftermarket is a very interesting growth avenue. It's a fragmented market, there's high growth. The return metrics are different. You can turn your working capital to drive those ROIC. So we're very, very focused on where we allocate constrained capital. We're on a constrained capital environment. We've got a significant debt load which we need to pay back. So we think about it rigorously and with discipline and allocate accordingly. I hope that answers the question.
Paul, I don't know if you want to add anything there, or we can skip to the next question.
No, that's spot on. No.
Maybe I can jump in there with a linked point, because I was waiting for AutoZone to feature in the Q&A, and I see a question has come through around it, and obviously I had questions around it as well. So word on the street around the time of that thing being in business rescue was that working capital was one of the challenges. I don't know if that's true or not. To the extent you can comment on that, it'll be interesting. But it is 6 to 9 months behind the recovery plan, and strategically, I think it's a good place to play because it'll smooth your earnings over time. You've got a big car park to sell into, so that makes a lot of sense. But obviously the turnaround is quite difficult. And the question is, just the key initiatives that you're following there to actually get this thing back to profitability and then suitable returns. Obviously, those are not the same thing. And then just anticipated timing of some of these profitability improvements.
Yeah, so the reality is that it went into business rescue because it ran out of working capital. It had large shareholder loans that were all waived through the business rescue. All the creditors were compromised, etc. That's what we acquired. So what are the lessons, and they're kind of personal lessons, right? So, and I'm the CEO, so I take full accountability. I probably gave the old management team a little too much leeway and time. We did put in working capital there, and they did have plans to put in place to get them back. And probably in around August of last year, we noticed it was just not getting to those. And there's some key stats. Trading sales per day, there's a key one. Every day, actually every hour, we get what's the sales. And it just wasn't making that move. And was that the right inventory we're putting in? Are they turning it? Are the people being trained properly to sell? They've been sitting in business rescue for 18 months. So, we had to change the leadership, right? That's on me. We had to change the leadership, and we've done that. And we've done that successfully. And we've brought in some really heavy hitters, and we've stolen them from competitors. We're not shy about that. And they're in place. We've supported that with additional working capital. Hence the renegotiation with the banks on all of the debt structures, and we've got that. So it's now time to see this team get into action. And so, we do well over the next 7 months to then get it 7-8 months to get it to break even, which is what we should have done in the second 6 months of last year. And after that, return to the profitability. So we're still very confident. We're on it every day. I'm very confident in the new team, and we really need to get AutoZone humming. I mean, you're right. The market, when we assess the size of the market, very fragmented, as you know, 3 big players outside the OEMs would be Goldwagon, Midas, and ourselves. But it's more than a $10 billion per annum market. If you added all the component parts together, it's a big market here. So we need to get this back to the profitability quickly.
Well, if I can just maybe follow on not so much AutoZone specifically, but the aftermarket parts and growing that up as we've kind of discussed and alluded to in the presentation to, that 50% mark, so that the 2 divisions are like roughly equal. Is that a completely organic growth story? As you just said there, get AutoZone back to profitability. There's other constituent parts aftermarket, grow those organically, or is acquisitions of some of these smaller players or in other markets, rolling out the franchises as a potentially you talked about, or buying stuff in some of these other Southern African markets. Maybe just talk about how you get from that kind of low 40s now up to the 50. In terms of the growth.
So it's definitely a medium-term goal. So we've had some specialists out here from the UK who've also got specialization in Asia and how those markets have changed. And their view is South Africa's probably 8 years behind how the UK has consolidated a lot more and become less informal. And so we're seeing that will happen in our market, and maybe quicker. And so you're right, the opportunity to aggregate other players is definitely on the cards, but we do have capital constraints. So certainly in the next 18 months, it's about organic growth. We're earning back the share that AutoZone used to have. And we've looked at those numbers from 22 and 23 and what AutoZone used to be. And that's where we need to get back to.
There's a question here in the Q&A, which is part of a bigger concept here, which is around obviously the current international environment and the energy shock and supply chain and everything else. I think that's a broader point, which is to say, from a currency perspective, from an energy price perspective, supply chain, what does the current environment mean for you guys? Is the business ticking over? Is there stuff you're very worried about? I mean, constrained capital is a term that's come up a few times. The balance sheet is still vulnerable. So I think people will always be nervous of external shocks.
So currently, and a lot of people, and it was a big topic of discussion with Toyota yesterday, there is a bit of a blessing sometimes being on the foot of Africa, right at the bottom. Currently, through the ports and through the containers and the imports that we get, we're not seeing constraint. Okay, so we're not seeing significant delays in shipping or not being able to get the parts that we require, and neither are the OEMs. So obviously, when it comes now to transport and logistics and the fuel costs, that's where we potentially see cost increases. But we closely monitor those with the OEMs. You know, at 16 Rand 50, you know, that's good for business. Okay, it's good for business. You know, 18, 19 Rand is a little bit more hectic for the business. So at the moment, and we're not being flippant about it, we monitor it. But let's put it this way: when I joined in 24, you couldn't get a container through the ports of Durban. You know, there was kilometers of blockage, and you had to have all the sea freight. That's not the case today. So currently, the OEMs and us, there are no issues that we see, but we continue to monitor it.
Well, we're coming up on time here, but I think we can maybe squeeze one more in before I hand back to Vanessa just to wrap us up here. You know, within the two divisions, there's a veritable like house of brands underneath both divisions. You know, specializing in different parts of different markets. Over as part of your strategic review, when you came in, was there a discussion around, you know, just creating a single uniform brand for, let's say, aftermarket, and a single uniform brand for OEM? You know, reduce complexity, marketing costs, you know, branding costs, you know, all of those things that all still need to be managed by somebody internally, and you know, to kind of give a bit of, how do I say, a bit of oomph to each individual segment and say, this is what we do and this is what we can supply you, and rather than each one marketing individual their individual products and services.
No, it's a good question, and I'll answer it this way. So I'll split it. So for the OEM manufacturers, it touches on a lot of nerves, right? Because people love their brand, and our guys love their brand, and I respect that. You know, they live and die for their brand and who they are, and the history of the brand, and the 60 years and 70 years, that brand name and why it was. So what we've done to counter that is we running the business in a little different manner. So let's take wiring. We've called it wiring. So the management of Hesto and Unitrade, we make the same. So you can keep your brands and you can keep your legal entities, but we're running as wiring. We've done it with our injection molding as well. So Lumitech does injection molding, Automotive does an injection molding. First Battery has part of it that does plastic batteries. So we call it injection molding, and we run it as one management team. You just may happen to have machines doing different stuff every. Keep your names, keep your brands. So that's the way we've thought about it and the way we've adjusted to it. When it comes to aftermarket, it's a little bit more challenging because First Battery, as an example, sell to AutoZone, but also sell to Midas and sold to Goldwagon, and AutoZone's the competitor. So you need to keep your channels very distinct. And although we've got a chief operating officer, he is the only person who straddles across it. And then those brands need to be very, very clearly separated in terms of our go-to-market. Brakes, for example, ATE would sell to AutoZone, sell to Midas, sell to independents. So it's very important to keep brand relevant for the aftermarket.
Very much. I will hand back to Vanessa now to wrap up.
Thank you, Mark. Thank you to everyone who chose to spend time with us today, but a special thank you to Paul, Alastair, and the IR team from Metair for making time to support this platform and to engage with retail investors. Our next session will be on Thursday, the 21st of May, and that will feature a returning and regular company to unlock the stock, and that is Calgro M3. That is all from my side. Thank you to everyone, and goodbye.